Take a closer look at the divergence in the Dow and the Nasdaq over the last month. Joining us now is Paul Hickey, co-founder of Bespoke Investment Group. Paul, didn't really understand. I was looking at some of your notes, and you were kind of bragging about being not too enthralled with technology since July, and kind of being glad that you weren't recommending it. The Nasdaq was around 10,000 in July. 13,000 now. That's 30%. I mean, you got negative way too soon.
No, yes. I mean, so we started turning on tech, but if you look at some of the reopening stocks and you look at some of the small cap stocks, which have done considerably better over that time. But the point of it was looking back to last summer, coming up with the point that we're going to start seeing above average growth in the economy and interest rates were going to start to rise. So that was going to impact some of these high tech, high growth stocks. So now that we're at this point, though, the thing to think about is what next. So there's widespread consensus that we're going to see much stronger growth this year. We're going to see, off the charts, and even that we're going to see strong growth next year. But then going forward, there seems to be a growing consensus that we're going to have above trend growth going years out. And the question you have to ask yourself is, what's going to be the catalyst for once we start to return to a normal baseline to have above average growth, going out in the out years? And that's a question investors have to think about here. And when you have some of these mega cap stocks, like a stock like Microsoft, which doesn't trade too much richer than the broader market, doesn't have any debt, and has better growth prospects, those kind of names start to look a little bit more attractive in this environment when everybody and the widespread consensus is that rates are going up, so tech can't do well. Where the correlation between tech and interest rates is at the most inverse level. It's at extreme inverse levels right now. So you have to ask yourself, will that continue? And usually it doesn't.
Hard to imagine that basis point moves. I think it might be like program traders and algorithms. You know what I mean, Paul? It's like long term, the prospects for a great tech company at 168 on the 10-year, oh, it's okay. At 175 on the 10-year, it's, oh, no, things are horrible. That makes no sense. So that is exactly what it's correlated to now with tech to the 10-year. But my question on the overall environment for stocks seems to all boil down to one thing. A lot of stimulus and free spending on one hand, and a lot of headwinds in terms of rising rates, rising taxes, and more regulation on the other hand. When does any of that ever come home to roost? The higher taxes, the regulation, if interest rates really do go up to 2% or over 2%, doesn't matter how much we spend, that, we're not paying for anything we're spending. So that could end up being a negative instead of a near-term positive, which it is right now.
Yeah, so I mean, there's a lot to unpackage there. There's a lot of variables to focus on there. But if we start to see rising taxes and we start to see more regulation, okay, that may not be, that's going to have a broader hit to the economy. And where's the target of that regulation? Does it go to tech? Yeah, well, that would be negative for tech. But do they, it just depends on where the regulation is focused, and then you have to see, react to that environment. But the broader perspective here of the economy is that we are going to see strong growth this year. The reopening stocks and the cyclical stocks are starting to have reflected that. But then what's going forward? We've seen a real great handoff between the large cap tech underperforming since September 2nd, which we call the beginning of the great shift, where we've seen the only one of the top 5 tech stocks that's up over that point is Google, but the S&P is up over 8%. That's 20% of the S&P 500 on average is down, but the S&P is up 8 to 9%. So we've seen a great rotation here, and it's gone through well, and the market's handled it in a very good manner, which makes us more constructive and more positive on that the market can keep rallying here. We see the breadth measures continue to show strong, very strong breadth in the market. We see the cumulative AD line continue to hit new highs. So I think overall it's a positive. And what you were saying before about interest rates, a few basis points, again, we had this conversation a couple of weeks ago that we're at such low level of long-term interest rates that, I don't know if the market was necessarily pricing in sub 1% interest rates for years to come in its valuation. So we could get up to we've had levels of 3% during this bull market, and the market has held up relatively well. So I think, sure, in the short term, it's painful and investors get very worried about things. But in the longer run, I think getting to 2% is not the end of the world here.
Shepard Smith here. Thanks for watching CNBC on YouTube.